Hi guys, this is Wealthwise by Samuel. Today we're going to talk about the stock market. So stock has been an investment channel and a lot of people have made a lot of money, including billionaires like Warren Buffett and Bill Ackman. So there are avenues to make money within the stock market. You can do buy and hold, you can do swing trading, you can do day trading, you can also short and do options. So those would be primarily normally what commonly people would do. But I'm going to talk about what are the 5 criterias that you will meet in order to be successful in the stock market. Personally, this year my return has been roughly 64%, which is 10% higher than QQQ. So I have used the investment philosophy myself. But before we start, just a disclaimer. I'm not an advisor. You are expected to do your own due diligence. And this is not an advice. It's what I would do. And it's my personal experience. So let's get started. So the first thing I'm going to talk about, and I'll write these down here so that it's easier for you to understand, right? So the number one criteria, you would research and validate. Right. So how do you research and validate? The fastest way is follow the leaders, use other people's research, because you do not have large teams or the tools what large FIIs or DIIs or large investors have. So what I would do is I'll follow the research done by those people. So they take out a form called 13F, which gives you the holdings that they have. So we're going to look at the top 10 holdings that these people have come out, and this comes out every quarter when they file 13F, right? So let's write it down. So we would do top 10 stocks that these guys bought, right? And we'll make a list of the top 10 and the name of the investor here. So that will kind of give you a shortlisting criteria, because you do not have the capability to do volume research, and you don't have the algorithms and the large teams that these people have. So FIIs, foreign institutional investors, large institutional investors, whether it's domestic or foreign, doesn't matter. Large investors, which are basically investing for people like mutual funds. So those are called market makers. So you will jot down the top 10 stocks from these large institutional investors. Number two, we are going to look at the finance side of it. So in finance, there are few criteria we are going to look at. So the number one is the cash flow. The second is PE, price to earning multiple. The third is basically assets of the company. And I also personally like to check within the assets, I like to check the account receivable. If the account receivable is very high, then that would make a difference between how the company manages their finance. You'd also want to check debt for the company. So that would be my second one. We're going to check the cash flow for the company. It's got to have a strong cash flow. You're going to check the PE multiple for the company. And the fundamental behind this is if the company is capitalized in a big way, typically if you are in the 10 to 25 multiple, then it's a good investment. But if the company is has a multiple of maybe 100, then you might want to think about it, right? The fundamental truth is it's easier to multiply 1 into 100 million, 100 million to a billion, but a billion into trillion would be tougher. And if you are a high market cap company like Apple, which is $3 trillion, you cannot expect to have $3,000 trillion. So that's not going to happen anytime soon. So keep in mind the finance piece of it. The third piece that we are going to look at is what kind of moat the company has. So moat is intellectual property. So it's the IP or the intellectual property. So the moat can be of two types. It can be a physical moat. It can be like a toll booth where a lot of traffic goes through, or it can be a monopoly business because you are the only ocean liner, you're only train that goes across the terrain, or you're only oil company which has a pipeline in the train, or you're only utility company that has the cable in that region or the towers in that region. So the moat could be physical moat or it could be a technical moat. So technical moat is like you have intellectual property rights to a software. For example, you might have created an IP for a software patent which some large organization is using, and then you have a moat because you own that IP. So you got to know the moats traditionally is basically the valley on which normally the water around the castle is there. So normally you would have like crocodiles and piranhas there, but you need to have a bigger and stronger moat in order to basically safeguard your investment. So that's number 3, which is a strong moat or intellectual property. Number 4, you want to stay in the new and exciting world. So just like human beings have a life, a finite life, companies, I believe, have a finite life. So some of the Harvard professors have propagated that. So if you're a 150-year-old company, you've already scaled up to $1 trillion, the possibility of growth is going to be low, right? So you want to go ahead into a new and exciting organization. The example is if Microsoft had an OpenAI within themselves, the growth of OpenAI would have been much lower, but as a separate company, the growth could almost go to maybe 50% of the cap rate of Microsoft in the long run. However, if you merge that with Microsoft, that might become a much lower net worth. It'll just give a small bump up. So there's examples in the industry like NVIDIA, OpenAI, Planeteer, right? I mean, there's Datadog on the AI side as well. So there's lots of companies which have come up with a new niche, new and exciting areas. So stay in the new and exciting, right, after the moat. So that would be my 4th criteria. The last but not the least, be aware of companies which depend on policies and geopolitical criteria. So if the company has dependence on government policies or is impacted by geopolitical, it's a high risk organization. Also companies which are with high capital outlay. So you're a brick and mortar company, you have tons and tons of malls where you need to kind of house your physical products. That could be a high risk. And in turn, if you are dependent on a government policies, right, or the system driven organization, which regulatory organization, for example, if the CPI is going up and if the consumer price index goes up, the Fed raises the interest rate and it kind of starts to bring the employment down. So unemployment goes up, right? The CPI starts coming down, but it has a ripple effect in the industry, and some of these industries will get affected big time. So be aware of companies which are policy dependent, we are impacted by geopolitical areas, and which are high capital intensive. So there you go, guys. If you do this 5 criteria selection for your stock, it's a great start. My personal return for this year has been 64. So I've made like 64.3% return against QQQ. I believe it has got 54% return. So that's 10% more return. So it's 10% more return than the average ETF. And this is a pretty good ETF. And I'll share my portfolio in another video and see how we made it. I'm also going to share some exciting journeys on how we multiplied the money. But please continue to stay with me, right? This video is going to benefit a lot of organization individuals, And the intention is to actually help individuals get into the financial freedom, help organizations get up to speed, help senior care, help unemployed and the education sector. So please like, subscribe, and share this video. And I hope this helps you, and we'll catch up again. This is Sam Mal signing off for Wealthwise by Sam. Thank you.